If you bought a home in 2023 or 2024, you've been sitting in the rate penalty box. Sevens, even up to eights at certain points in the market. But we've shifted now and the game has changed. Everyone wants to know whether to jump now or wait for the perfect 4% that may or may not ever come. Welcome to the UM Show. My name is Kelham Brown. I'm the mortgage official, joined by Dave Brown, the mortgage coach. Coach, I'm seeing people on social media saying, hold the line, rates are coming down. We'll see 4% by Christmas, but you've got 30 years of experience of seeing these cycles up, down, left, right. What can you tell us on your insights of where you think rates are going in 2026?
Yeah, that's a great question. And so let's dive in. So first of all, for those that have bought in the last 3 to 3.5 years, you literally could be sitting in that zone you talked about. Now, here's the thing. I don't have the absolute crystal ball, so to speak, but what I do have is really good data. And I'm backed by some of the best financial economists in the real estate and mortgage world. And here's the crazy thing, Kel. Not one of those people are saying that we're going to hit 4% in the next 12 months. Not one. Now, if you're listening to people online that are putting posts out there that are saying that, let's talk about it, because you could be missing it. Everybody's kind of saying that we could see rates, really settle into the mid fives this year, which is amazing compared to where it's been. So what I need everybody to understand is how interest rates kind of move. Can I dive into that real quick, Kel?
Go a little bit further, just because who are the people selling 4%?
Yeah, well, I'm going to dive into that and tell people, because you can get there, but it's going to be very painfully costly to you to do that. All right. So here's what happens in the interest rate market. And interest rates at the time of filming this, interest rates are at the lowest that they've been in the last couple of years, which is really exciting. Now, the Federal Reserve, everybody hears about the Federal Reserve. And the Federal Reserve, they move based upon expectations, not just things that happen in the meetings. And so what do I mean by that? When we know that the Fed is going to have a meeting, we will typically start to see interest rates move in advance of the upcoming meeting. And that's because the financial markets, the stock market, the bond market, and interest rate market, which I kind of put that as a separate market, that's called the mortgage-backed securities. But just think of it all as the financial markets. They have kind of information that you and I don't have. We start to get hints about what the Fed is thinking. And so the market starts to move in a direction up or down based upon what they think the Fed is going to do. And so the Fed has been relying on data. Inflation has been coming down. And so they've been lowering interest rates slowly. But here's what I want to tell everybody. Don't kind of skip over, dollars, trying to pick up some dimes on the way there because you think that rates are going to hit 4%. I hope they do. But here's the thing, we can't operate off of hope. So let's talk about real facts on this show, because literally, let's say you can save $350 a month by refinancing. That's significant money. That's over $4,000 annually if you could save that kind of money. What are you going to save if you potentially wait? Maybe the market drops another eighth to a quarter in the future, but those are the things that we need to talk about. I think it's all great information, and we're going to dive into more of that here on this show. But Kel, I've got a question for you. For the people that bought in the last couple of years at a higher interest rate, and so I want to kind of, get this question right for you. So if somebody had a $440,000 loan, let's say at 7%, right? If we can move them into something, into the mid fives or higher fives, all right, and there's different qualifiers, what does that actually do for their life?
We just had this come up. So that 440,000 client was about 7%. And so just in principal and interest, if they were to get into, let's just call it 5.75, right in the middle of 6.5, right dead center. And you're almost dead on at about $360 a month, about $4,300 a year. That's a vacation. That's car payments, college funds, reinvesting in mutual funds, 401ks. That's real money in people's pockets that can save them on their day-to-day. That's not $100 a month, $1,200. That's real savings that people can deploy to paying off other debts and actual things they can do with that to make a difference in their daily lives.
Yeah. It's big money. It's real money. And that's why I say in the beginning, you asked me, if people are waiting for that magical, mystical, as an example, 4% rate, are they missing out? And is it a financial mistake? And the answer is it might be, kind of coming back to that, because $360 a month in that scenario of what we just were working with is real money. If they waited, let's say they waited a year and maybe rates dropped another quarter, that's not going to save them that much more money, and they lost out on that $360 every month while they waited on rates to potentially drop a little more. So these are the things we always have to talk through with the clients. And I think we do a really good job at that. But if you're listening to this, you've got to get this kind of information to see, is it time now, or when is it time for you to do something?
Right. And we use the example of 5.75, but we're seeing ads online for 5.25, 5.5, some are even sub 5. And homeowners see that as a slam dunk. Why would I not save in that scenario over $400 a month? But walk us through the fine print and what does that actually cost for the cheapest rate or the lowest rate that's kind of hidden in those fees, that's hidden in those ads?
Yeah, that's really good. So let's dive in first. Everybody needs to understand when you refinance, it's just like when you purchase a home. You typically have to do all of the same things again. We have to order title work. In some cases, we have to order an appraisal. Now, depending upon certain loans, certain credit, we can get appraisal waivers on a lot of loans. But for the most part, you still have many of the same closing costs that you did when you purchased a home. There's a line item that people don't talk about a lot, and it's called discount points. And I think we need to break that down for everybody first, because this is important. A discount point is, each discount point, first of all, is 1% of the loan amount. It is a closing fee. Not all loans are equal. Not all loans have a discount point or more than one discount point. All right. But discount points are fees where you're paying, think of it this way, you're paying discount points upfront to buy down a lower interest rate. You'll hear that term, buying down. All right. So let's just, keeping things really simple. Let's just say that interest rates, because I like to keep things simple, let's say interest rates today were 6%. And that was a 6%, no points whatsoever, no discount points. But if you paid 2 discount points, you might be able to get that interest rate down to 5.5, 5.625, something like that. But it costs you 2% of your loan amount. That means you either have to bring that money to closing, or out of the equity in your home, you have to use that to pay those fees. All right, so that's the first thing. Here's a real life example, okay? And this is where, to your question, people ask all the time, well, I want to get the lowest rate possible. Just the other day, I had a client that we're working with call, and he said, hey, I really liked the rate you gave me, but I decided to just check around and I got this estimate. Can you meet or beat it? Okay. It was a little frustrating because we've talked through this and so forth, but this is what we do. But it was the way he posed the question that was frustrating. Had him send over the estimate. And when he did, I was able to quickly, just literally within the first 7 seconds, see on the line that said discount points, he was being charged 4 points on a $400,000 loan amount. Well, that's $16,000 in additional fees that he was going to have to use of his equity. Now, in our consultation, everybody, I knew from talking with him, he plans on being out of the home in probably 5 to 6 years. So therefore, he has to make sure if he's refinancing, he has to be able to recoup the fees that it costs to refinance through his savings in that time frame and have a gain, right? And when I looked at that, I called him immediately and said, listen, did you intend to pay 16,000 in points to buy your rate down? What changed? And he said, I didn't catch that. So that's the hidden fees that you have to be careful of. We could literally get somebody a rate in the 4s today, Kelham, depending upon a lot of factors, but it could cost a lot of money. So guys, if you hear nothing else today, you have to really check the fine print. It's more than just the rate. We've talked about this on other shows. It's not just the rate, it's everything underneath that rate that you really need to look at. Sometimes that 0 point rate is the best way for you to go, because you may only want to stay in the home for a shorter period of time. This is where we sit down and figure out where's the break-even point for you, so that you know what your target rate needs to be to make sense to you, because it's different for everybody. Did that kind of answer that, Cal?
That clears up quite a bit on the matter. But there's another part of this that I wanted to touch on is our investors. Because during that COVID period when rates were 3, 4, 5, and then up to that 6%, like you said, that's still cheap borrowing money for investors who are buying up a bunch of properties. So is it just about lowering payment, or do they have a bigger play that could even help them scale a portfolio?
Yeah. With the investors, a couple of things can happen. So sometimes an investor can take some cash out of their property so that they can go acquire more. That's one way that they can utilize that, because they were able to buy properties at lower dollars at the time. And so they might have been able to accumulate equity quicker. The other thing that investors are able to do over the last 3 years, as rates were accelerating, think about this. If the fixed rate for a primary home was in the high 6s and into the 7s, the rates for investor properties, and we've talked about DSCR on this show, they were even higher than that. So think about if an investor can maybe lower their cash flow on their monthly payment several $100s a month. That creates an ROI increase in their equity or in the value of their property. And when you look at their balance sheet, that's a significant gain for investors. And so there's kind of two things. One, they can pull money out to go purchase additional properties now at better interest rates than maybe what they were getting over the last couple of years, and also just refinancing to save money, which then drives up the ROI on their overall properties, which is also very important. And I think that was a great question, because that's missed and overlooked a lot of times. But again, just that overall equity play, Kelham, when you sit there and think about with a client, when you were talking about the one for $440,000, you think about that $360 a month in savings. That's real money that goes back into your budget to start paying off other debts. Think about this, $360. People are sitting out there with $8,000 and $10,000 credit card balances that are what? $350 to $500 a month on payments. That you could literally take that and start knocking out. It's like knocking out your credit card debt. So it's a great question. So I've got one for you that I want to ask, and this is important.
I want to pause you right there, because you mentioned something really important, is the credit cards. Those are at interest rates in the 20s, and people are worried about rates in the 6s.
Yes. Well, that's, you bring up a good point. So some people would say, well, why would I ever want to get off of let's just say somebody has a mid 3 to 4% interest rate. Why would they ever refinance at a high 5 or a 5.75 to 6% interest rate? Why would they do that? Would it make sense? Not always, but sometimes, because what we have found, and a statistic out there, is credit card debt in the country is at the highest level that it's ever been. I think that, I don't have it written down because I didn't know you were going to ask that, but the last I saw, we're approaching $1 trillion in credit card debt. That's crazy, right? Mm-hmm. And so think about that. So somebody that's paying 18, 20, 22, 25%, and then all of a sudden they could absorb that debt. So sometimes it's not just about lowering your mortgage payment, if we can also lower your overall expenditures, there are times that it does make sense to do what's called a cash out refinance so you can stabilize your monthly payments. There's times where let's say we could only save that potential person $360. There's examples of that same borrower where if we were to cash out and get some additional money out for them, we could increase that savings sometimes well over $1,000 or $1,500 by paying off people's credit card debt. And that starts to become substantial. So that was a great pickup on your part. I really think it was, because people overlook that thinking, oh, I have to always keep that low rate. Sometimes you do. And again, this is not one size fits all. That's what we want everybody to understand. You really need to look at it. So, all right, I'm excited to ask you this. Talk about the skip a payment myth. I've heard this out there. I hear lenders telling people, oh, you get to skip 2 months payments. What is that? What is that?
It is a little bit of smoke and mirrors. The concept is there, but it is how you allocate the interest. So interest is always gathered on the days that the loan is due. So every single day that you live in the home, the 1st through the 31st, interest is collected on every one of those days. So depending upon when you close in the month is how many days of interest will be collected at closing. So you aren't necessarily skipping as much as you may be financing a 60-day break. So that can either be paid out of pocket or financed into the loan. But that's where you'll see these lenders say you can skip 2 payments. You're not going to pay it out of your pocket necessarily, but it is going to get tacked on to the back end of the loan. And it might be the most expensive vacation you've ever taken by going from your bedroom to your kitchen.
That makes sense. So let's dive deeper in that. So you can actually skip writing the physical check. So let's talk about that. So if you're refinancing your existing mortgage, right? I'm assuming, what does that mean? Would they get to just, like when they get a new loan, if the payment's due in April, they just don't have to pay for 2 extra months? Or where does that 2 months actually come from? I think, weren't you telling me before we recorded this, the 1 month comes from the existing mortgage that you have, and then the payments always due 30 days later on the new one? How does that work?
Correct. So either on a purchase or a refinance, you skip the following month. So we're currently in March. If you were to close a loan in March, you would not pay the March payment for the 15th, so you wouldn't get a mortgage late payment on your credit report. You would then skip the April payment for your new mortgage because it would be processed, closed, funded with the lender, and then your first payment would be May 1st. So technically, you wouldn't have a payment from March until May, but like I broke down a little earlier, with those interests collected, you're still going to be paying interest on those, but you may not be writing a physical check or coming out of your bank account.
But sometimes, again, Kelham, sometimes when we look at the overall picture, that's okay. I mean, it's all part of the cost of getting a refinance and also the overall savings. And these are just the things we have to break down. So, all right. So, Kel, I need you to blow the whistle. We are ready for the 2-minute drill.
Run it.
All right, 2-minute drill. I'm gonna ask you the question today. So here's what I want to know: if somebody is sitting at home and they're sitting out there with a 6.8, 7.5, 7, 7.25, whatever, a mid-6 and above rate, how do they know? What's the exact number? Is there an exact number they should be targeting to know if refinancing is right for them, or how do they know?
I think you hit it on the head. There isn't a one size fits all for every single borrower, but I would say about 0.5 to 0.75% without charging you thousands in junk fees. The conversation really starts there because, like you said, in some instances, someone may only drop 0.25%. They may stay the same, but if we could tap into $100,000 worth of equity and pay off all of their credit cards and their car loans, and they could be in an only mortgage debt situation and clear up $1,000 or $1,500 a month, their rate may have not gone down, but their overall bill expenditure may have. And then in some cases, you could still drop 0.5% or 0.75 and save a couple $100 a month on principal and interest. There's no one size fits all to every situation, but that 0.5% is really where the conversation starts in the scenarios that we can work up to help the individual.
Kel, we threw out a lot of information in a short time period today for everybody. The whole key is read the fine print. You need to check. You need to get some information. We'd love to help you. And like I always like to say, don't be a victim of the approval trap. You need to just be aware. And thank you for joining. Like, share this program with others. And if you would, come back next week. We will see you here, the Brown Mortgage Group, for the UM Show. Kelham, have a great night.
See you, everybody.